Hey, it's Jim, and this is level 3 of the CFA program, the topic on portfolio management and wealth planning, and the reading on portfolio management for institutional investors. And this is part 2. Let me just quickly remind you that we went through the commonalities between and among the institutions, and then we focused on their differences, and that led us right into the discussion of the investment policy statement. Then we talked about time horizon and liquidity needs. What we're going to do here in the second part of this reading is take a look at, kind of adult topics there, legal, regulatory, at least in my estimation. Tax constraints, these might be dull, but they're probably really, really good exam questions. We'll spend some good time talking more about defined benefit plans, and then we'll move back into the policy statement. And we'll look at things like asset allocation and maybe some other kinds of constraints. And then we'll end with a fairly interesting mathematical construct that allows us to dive deeper into the balance sheet of banks and insurance companies in that last LOS. Even though the LOS asks us to describe, we're going to do some math, and it's probably a good potential exam question. All right, let's start on this first LOS here in part 2, and we'll go through each of the institutional investors. Lots of this is repetitive from what we did in part 1. I'll go ahead and try to emphasize some of the new things in this for this LOS. All right, so for pension funds, some of these legal and regulatory constraints. I think that first one is probably the most likely exam question. Look what we have in bold over there: capital adequacy. What are we doing here? We need to make certain that we're acting in the best interests of our beneficiaries, which are current retired workers and future retired workers. And we want to do that with some integrity, some honesty, some monitoring, some transparency. So look at that third one there. We want to make certain that all of our plan beneficiaries know what's going on. And then linking that back up to that top row, capital adequacy and consumer protection. Those make perfect sense down there. Here's some good examples of regulatory agencies: Australia and in the United States, and then this Europe's IORP. That's really a kind of a cool word to say, IORP. Institutions for the occupational retirement provision. I can't imagine the Institute would ask you questions about here. Just be aware that every jurisdiction has its own kinds of rules and laws and regulations. So I'm guessing that inside of the question stem, you would be told something like, hey, here's a country, and in this country they have some regulations and rules associated with the legal and binding payments into the pension fund for all of the workers. So there's an example of Australia's superannuation guaranteed trustees. But I think these are the more important questions and interesting questions about tax treatments. Of course, whenever I contribute to my my pension, that amount is not taxable today. It'll be taxable when I retire and I take that income. So remember, there are a couple of things here: favorable tax treatment, and then the potential for lower long-term capital gains, so that in the end, I might benefit from a tax saving standpoint. But notice what that second block point tells us: that encourage lower turnover strategies. That's probably a really good exam question. Some countries might have higher taxes on derivative profits to discourage their use. I'm never in favor of A, higher taxes, and B, discouraging the use of derivatives, because as we have seen, these derivative contracts can add tremendous value to the spanning and to hedging and even speculating, if you want to go that far. So they have, the advantages far outweigh the disadvantages. I mean, we hear about the disadvantages reading the Wall Street Journal every day, where some derivative trader, made some massive mistake and lost $1 trillion. But that's not the fault there. That lies inside of this whole arena of managing operating risk. It's not the derivative contract's fault itself. We need to consider whether we're investing here inside of our domestic country or somewhere else. Worry about tax credits, worry about double taxation, worry even about triple taxation. And there are some guidelines, excuse me, there are some guidelines down at the bottom between different kinds of accounting rules and regulatory bodies. Moving on to sovereign wealth funds, remember in part one, we talked about those, 5 of these different types of sovereign wealth funds. So make sure that you remember and are able to distinguish the difference between and among each one of those. But from a legal standpoint, these wealth funds, were started by the government. So maybe it was the lawyers and the legal scholars and Congress or whoever, Parliament, whoever it is, would create this sovereign wealth fund, and so then that contributor is then responsible for making all the rules about how do you make contributions, how do you withdraw, what kind of governance structure there is, what is the mission. Remember, each of those 5 different types of SWFs had a little bit different kinds of missions. Of course, they have specific rules regarding asset allocation. And doing some background research, I went to look at the Norway Sovereign Wealth Fund. Has over $1 trillion in it. And in just a little bit of a research, I found a list of, maybe 100 different global companies in which Norway, at least this sovereign wealth fund, is precluded from investing in because they are in a business that Norway has decided that they don't want to be a part of for whatever reason. So specific rules regarding asset allocation. This is probably similar to what we've talked about in level 1 and level 2 in terms of screening for potential mutual funds or potential external managers or even just individual stocks. So that's kind of a screening thing. All right, transparency, accountability, and independence. We've talked about that for a long, long time. There is an international forum that promotes best practices. Yeah. Let's see, these are probably tax exempt, at least inside of the country, but then outside of the country, there might be some tax implications. Let's see, legal and regulatory constraints for endowments and foundations. As an endowment or a foundation, we're required to make these investments based on a total return basis. So, add interest income and dividend income to capital gains. So this is modern portfolio theory that tells us that we need to diversify. And there are some acts that were passed in the US and in the UK that say things like, those really, really smart dudes in the old days, like Modigliani and Miller and Harry Markowitz and William Sharp and Eugene Fama and Stephen Ross, all those dudes, they were really, really smart. And even though their models are not perfect, and we have found fault in some of those models, what they do is they allow us to kind of focus on a core, and then we can expand out by relaxing some of their assumptions. So, of course, modern portfolio theory plays a role in these legal and regulatory constraints. Typically, they have this tax-exempt status. Gifts and donations are usually tax deductible. Now, here in the United States, President Trump raised that standard deduction so high that lots and lots of individuals then, when they make donations, don't have enough deductions to qualify for the itemization. So that's probably, somewhat limited in that tax deductibility. It depends on the tax rules, and that makes perfect sense. Yeah, income and capital gains on assets are usually tax exempt. I know that what lots of colleges do is that they make donations to the surrounding municipality in lieu of paying things like property taxes or whatever other kind of taxes that they're exempt from. So, all sorts of institutional investors can voluntarily contribute to the operating budget of these taxing authorities that are in the area. And there's some differences there between US and UK. Go ahead and get your phone out again, take a picture. We did this a number of times in part one. Here's a really good slide on legal and regulatory constraints that compare banks and insurance companies. Notice that when you read through the two columns on the right, there's a lot of similarities between banks and insurance companies in terms of, look at what we have in bolded there, capitalization, that's important for both. Liquidity, that's important for both, but remember that insurance companies have a different kind of liquidity need than banks tend to. So those are probably really good exam questions. Look down there under liability management. What does it tell us? Diversified funding sources for banks. But on the insurance side, we've got to worry about life insurance policies and auto insurance and liability insurance policies. Stress testing is important in both columns, but for insurance companies, what the regulators require is some kind of proof. Of course, this is economic or mathematical or financial proof of the ability to survive, some kind of a financial downturn. Back on the bank side, we've talked about this just a little bit in terms of using value at risk, in terms of stress testing, in terms of looking at that left-hand tail of the distribution for banks. In other words, suppose interest rates spike, by 500 basis points on one day, what is going to happen to the banks? Well, the banks and the insurance companies are probably going to have a little slightly different reaction to that. I mean, it's not going to be good news for either of them, but the insurance companies probably can weather that a little bit more than having a run on banks. I mean, you watch the news and you see a run on bank. Didn't we just have that at some time in 2023 at SV Bank? Rarely do you see people standing in line outside of an insurance company. Yeah, look at the bottom. There's the word stringent there. We got lots and lots of accounting and disclosures, and then link that back up to the very top row where banks are regulated at all different sorts of levels. Insurance companies are typically regulated at the state level here in the United States. And then, over in other countries, maybe in Europe, there's the Basel requirements and other kinds of things. Yeah, look under accounting there in the middle, stakeholder communication. So this is a big topic that we talked about back in part one. Who are the stakeholders? Who are the important groups of individuals and organizations inside of there? And so, of course, these stakeholders are going to require some type of clear and concise and brief, do I want to put that word in there, and transparent financial accounting. So we have rules somewhere in the United States. We have rules throughout the world. What typically happens then for regulatory purposes, because those regulations are so conservative, then banks and insurance companies are probably going to show lower earnings. That's why it's so important as a good financial analyst, when looking at a bank or an insurance company, you also look over at sustainable operating cash flows. And then I shouldn't have to read that green diamond point for you. Make sure that you do all this at market rates of interest. Banks and insurance companies face complex industry-specific tax rules. When I teach, every once in a while, I'll teach a financial institutions class, and we talk about those tax rules, and I always just say, hey, you know what? Here's the tax expense. Let's let the accountants worry about it. I can't imagine that the Institute would go ahead and ask you about the vagaries and the granularity of those specific tax rules, but just be aware that there are complex issues, and that they might influence the strategy for other things, like maybe asset allocation. All right, how about moving on to the next LOS, evaluate risk consideration. So what I want you to do is I want you to think about what that term risk consideration means. Think about the balance sheet. Now remember, we're talking about these defined benefit plans here specific to this LOS. So think about the balance sheet, think about the cash flow statement, think about the income statement, and what are we trying to do as the defined benefit pension fund manager? We're trying to collect all of the capital from the employer and invest it somewhere, and then generate enough cash flow so that we can meet the promised payments to the current retired employees, and then have a buffer for all those future retired employees. So what is the risk? The risk is that A, we're not getting enough money from the employer. The risk is B, that we're taking it and we're losing it all in some kind of a market. And then C, we don't have enough capital to make those promised payments to the beneficiary. So that can be summarized by the plan funded status. So the Institute is very, very likely to give you some DB plan and say, hey, it's operating at a surplus, it's operating at a deficit. So those are key words there that are going to be informative for what the potential questions are. So fully funded plan has, these have assets, market value of assets, which are present values, right? Greater than or equal to the present value of those liabilities. So if you have lots and lots of a surplus, then that leads to the manager being able to say, you know what, maybe I can go over here and invest in this particular risky stock. So greater risk tolerance. Underfunded plans carry a tremendous financial burden liability for the sponsor because you think about it, you know, what's the goal of the employer over here? What's the goal of the business? Maximize shareholder wealth. What that means is we need to find positive net present value projects. Well, suppose we have a positive net present value project over here that has an initial cost of, let's say $100 million, but our pension plan is underfunded by $100 million. So what do? Do we invest in the positive NPV project, or do we throw all of that capital into the pension? Well, according to the rules and the laws of that particular state and that particular contract, we might be required to go ahead and put it into the pension. So that's a financial liability for the sponsor, either in today's opportunity cost of foregoing those positive net present value projects or some future opportunity cost. It's always great to go back and remind ourselves that the discipline of finance came from economics, and that opportunity cost, that goes all the way back to, I'm pretty sure that the Roman Empire and the Phoenicians, they knew about opportunity costs. All right, look in the orange box. This is pretty good potential exam question. So how can we minimize this kind of risk that I was just describing? Well, we can go ahead and say to ourselves, here are liabilities over here, and our liabilities have these kinds of characteristics. And of course, we want to define those characteristics as things like, yield to maturity, as things like time to maturity, as things like duration, as things like convexity. So we have all that stuff over there on the right-hand side of the balance sheet. How does that relate to the assets that we're investing in? If we have let's say a modified duration on the right-hand side of the balance sheet of 5, and over here on the asset side, we have a modified duration of, let's just pick some crazy number, 50. Well, what does that tell us? That tells us, boy, if interest rates go down, we're going to be cheering and high-fiving each other because we've got massive increase in the value of our assets. But if interest rates go up, well, then we're going to put a sign out on our door saying, sorry, we made a huge mistake in managing interest rate risk. All right, so liability-driven investing approach. This is super important. How do we do that? Invest in assets with higher rates of return to outgrow liabilities. Now, that's a marginal cost, marginal benefit, speaking of using our economics knowledge. Yeah, defensive assets for less volatile returns. Yeah, that makes sense. So, notice that the red and the green bullet points there seem like they might be mutually exclusive, because assets with higher returns are probably going to be those that have greater standard deviation. So once again, let's go back to 1952 and Harry Markowitz and try to balance that efficient frontier of the need for the higher returns and then also the desire for lower volatility. Yeah, I love this last bullet point here. This is the accountant in me. Adequately funded plans can eliminate balance sheet volatility. All right, so this is what we're talking about. I didn't learn about balance sheet volatility as an as an undergrad accounting major, although maybe I did and I wasn't even paying attention back then. But in graduate school, when I was working on my MS, we took this balance sheet and we started talking about standard deviation and how it applies. And here, excuse me, it clearly applies to pension risk. The Institute is likely to say something in the question stem about the sponsor financial strength. They might say something like, oh, this company has branded product lines. It is able to generate sustainable cash flows into the expected future. It's a market leader in these individual product lines. So those are kind of signals to say, hey, these are great financial strength. Signals of poor financial strength would be something like, hey, this company stinks. Now, they probably won't say it that way, but they might say something like, hey, this company used to be second in market share. Now it's eighth. Cash flows have been declining over the course of the last 5 years. Free cash flows are negative because we had this need to go into the bond market. So there we go. We bring in the specter of leverage and all that other kind of stuff. So there we go. Financially weak sponsors, that makes perfect sense, right? Now, I always use this Enron example explaining the green box. I think I did this back in part 1 here. So imagine, let's go back to, what year was it? 1997, 1999. If we're Enron employees, what are we doing? We're generating a salary. We're also accepting shares of Enron as part of our compensation. We're accepting Enron shares and putting that into our pension plan, and then we're employed, right? So when Enron goes bankrupt, we lose our life savings, we lose our retirement, and we lose our job. So these interactions here, we could probably say something like, correlation coefficient. So what we want to make certain is that the key sentence in the question stem the Institute might offer us is something like, okay, here's a company, let's call it Jim's Concrete Company, and has a pension, and in the pension it says something like, 50% of the pension assets have to be in Jim's Concrete Company stock. Well, that should set off flashing lights, and you should say, wait a minute, where's the question which says this is totally unacceptable? So this is essentially something, another of these modern portfolio theory advocates who say something like, diversification. Now, lots of these plans say something like, okay, no matter what, you can retire. You have to retire. You have no choices to retire when you turn 67 years old. That's just it. But of course, the plan designers would like to have flexibility to attract, more and more talented and highly skilled employees. So they might offer early retirement. They might offer 5-year annuity. They might offer lump sum. They might offer. I mean, you can construct these benefits in almost any way that you want, according to the laws, the tax laws of that municipality or whatever the federal government allows. So what happens then is that if you allow early retirement and you allow lump sum distributions or even shorter annuities, most of these plans, at least way back in the old days, would say something like, look, on the day you retire, let's say you retire when you're 60, and suppose that you live for 60 more years. You live till you're 120, we'll pay you $82,000 a year. Think about what that means. 60 years of $82,000. I don't know what pension plan can survive something like that. So even if they say, we won't pay you for the rest of your life, we'll pay you for 5 years or 8 years or whatever that is, notice what that tells us. It reduces the duration of the plan liabilities. And that's really probably an important question for asset allocation stuff. Yeah, if we have this poor plan design, which is probably the one I described earlier, we can adequacy and sustainability of those benefit payments. Yeah, that makes sense. If you read the Wall Street Journal regularly, like you should be doing, you will read about overly optimistic future contribution predictions. Employers will often say, oh yeah, we have this positive net present value project. It's going to pay off in the next 5 years. When it pays off in 3 and 4 and 5 years from today, then we'll go ahead and fund the pension. There's another flashing light signal that you should look for the question that says, that stinks. Workforce characteristics, this is a little bit of a repeat of what we did back in part 1. What do you need to know? Turnover, you need to know vesting, you need to know what is the age, the average age, because that's going to impact the duration of the assets, it's going to impact risk tolerance, and it's going to impact the liquidity needs. Don't forget that bottom circle point about longevity risk. I think I gave you the example back in part 1, somewhere in there about my father, who, when he was alive, he worried about outliving all of his assets, and then he was always also worried about dying next week. And I told him to pick one. You can't worry about both of them, Dad. And I said, look, if you live, you can move into my sister's house. All right, moving on to a couple of LOSs that we combine here. You know, these LOSs could be summarized by just one LOS that says, hey, tell us everything you need to know about the policy statement. All right, so what about investment objectives? Now, remember, in the old days, the Institute was very keen on distinguishing between the return objective and the risk objective. And what it has done in this last iteration of the LOSs is to kind of refine those and lump those into more of a linkage between the two. You know, so investment objectives think in terms of both risk and return, and they have to be related. In the old days, you know, it was almost like they were separated, and then you had to force them to be linked. But now this new approach, you know, kind of has a direct link. All right, so what are we doing here? Notice that these arrow points, what have we bolded? Long-term return and portfolio risk. All right, so risk and return objectives are part of that same investment objective. Now, what's important for a defined benefit plan is that we have some kind of an actuarial discount rate where we're computing the present value of the future pension obligations. What we need to do is we need to make certain that the return on our assets, right, our portfolio return, our expected portfolio return, which of course is going to be a diversified portfolio, and it's going to be a function of entire portfolio risk. And remember now, there's no reason why we can't throw in equity securities and fixed income securities and all sorts of alternative investments. Although, you know, we need to put a comma there and pause about the alternative investments for pensions, but there's no reason that we couldn't do it. We might not want to, but we could. So that rate of return, that has to exceed that actuarial discount rate. And remember, that rate is going to be provided to us by the actuaries who, and maybe some of you guys are actuaries. I do know that every actuary that I have met during my lifetime, I thought, boy, this person is smarter than I am. That may not be true, but at least they give the impression that they are. Now, of course, these defined benefit plans are going to look at both sides of the balance sheet, which is what I just said earlier. What this slide is a focus on is the relationship between the assets and liabilities from a liquidity standpoint, right? So we can do this with ratios, we can do this with contribution rates, we can do some kind of a liquidity stress test. Notice that long-term primary objective is what we said earlier, and then there is a secondary objective as well, which relates to the contributions that we're making. Defined contribution plans, which is what I have at my college and what I do. I contribute something and my college contributes something, and then I direct those funds. I think we have 3 choices of different investment banking firms. And so I pretty much say, you know what, I'm planning on living for a long time. Put it in the entire stock market index, you know, whatever that thing is called. what is Vanguard? I don't have Vanguard, but what does Vanguard call this? The Vanguard Total Stock Market Index. So that's where I throw most of my stuff. And what does that say? I'm 61 years old. I'm gonna continue working for probably 6 or 7 or 8 years because I love teaching, and it's not a super high stress job. Like you guys probably have way more stress in your daily life than I do. All right, so that's what I'm doing. And that means that suppose all of my investments, they crash down to a value of 0 on the day I retire, and I'm going to say, okay, I need to get another job, right? So these investment options are tailored to, age, risk tolerance, return requirements, number of dependents, all sorts of things that we've talked about are relevant for the individual policy statements that we did back in a previous reading. Investment management can be in-house. Yeah, that makes sense. Balanced asset allocation. Let's see. Pension fund allocations vary greatly by country and even within a country. So we need to worry about these legal and regulatory and tax constraints that we talked about at the beginning of this slide deck, the investment objectives, demographics, and investment opportunities. So there are the various asset classes. There are the others down there, which can include, almost anything else that you think about. Equities. One potential good exam question will link our conversations on behavioral issues. Remember, we have cognitive errors up here and emotional biases here. There is tremendous evidence of a home bias, meaning that we put together a policy statement where we have domestic equities, domestic fixed income, domestic alternatives. So be aware of the home bias under all of these things, but primarily in equities. Yeah, fixed income. Why do we invest in fixed income securities? To generate lots and lots of income, right? The coupon payments that we receive. And so the Institute has emphasized that this is a defensive role. What we could also say mathematically is that, of course, fixed income securities, they have low, maybe even negative correlations with equity securities. So that's the defensive part of that conversation. And then, of course, if we throw in alternative investments, which typically include real estate and other real assets, there we have low correlations down there. But when you go into alternative investments, you probably don't know nearly as much about it. And that's true for us as individuals, and it's probably true for pension fund managers and all of these other institutional managers, that they'll have to go and do some research. But the Institute is teaching us in the LOSs for level 1 and level 2 and level 3. If you don't know something, then just go figure it out, right? If you have a client that wants to invest in some ice sculptures that are made in Iceland that have to be kept at a temperature of a minus 500 degrees, you buy it today for, $10,000 and you hope to sell it 10 years from now for $100,000. Well, that's a great return, right? But you probably don't know, at least I don't know anything about the ice sculpture market, but I could probably find out about it in a relatively short time period. Now, one of the important things that the Institute emphasizes down there in the bottom is that these real assets, they probably, I don't want to say this definitely, they probably act as an inflation hedge, because if you own an apartment rent building, then with inflation, then you'll be able to get a higher rental income from those units. So it doesn't always work. We've seen that with COVID and all the rules and regulations about putting maximums on rental income. Here are those 5 sovereign wealth funds. So what are these different objectives? I think we had a good slide on this in part 1. So this is a little bit of a review. Go ahead and get your phone out and take a picture of this, and then link this back to the picture that you took in part 1. Asset allocation. Of course, this depends on a couple of different things, a couple of different funds. Some are restricted. Those budget stabilization funds, that makes sense. They're primarily in fixed income, because what we want to do is we want to take those coupon payments and then throw it into our budget, right, to stabilize from higher and lower tax revenue stream. Savings funds, they do growth assets. Reserve investment funds, they do equities and alternatives, but they have probably less allocation to alternatives. So you got a picture of that. Go ahead and make sure you see the reasons over on the right-hand side. This is probably the source of the exam question. It might say something like, hey, here's a fund, and we have some restricted asset allocation restricted to, maybe these things. And what we would like to do is we would like to build a bridge, or we'd like to build some technology, or whatever that is. And so here are some questions, hey, what kind of a sovereign wealth fund is this? And then you say development fund. University endowments, what is the investment objective? Well, I can tell you the investment objective of my college's endowment fund is to be around for a while. We hear that from the administration, we hear that from the board, is, their goal is to make certain that our college is here today and next week and in the next decade and then in the next century, right? So what that means is that we want to maintain the purchasing power of those endowment assets. We want to grow the endowment assets. And of course, we're going to dip into that. Maybe 2%, maybe 5%. What did we say in that part one recording? Maybe up to 7% or 8%. Actually, some endowments, they can go, they could do 100% if they wanted to, but that doesn't make sense to maintain purchasing power indefinitely. Yeah, I know from reading the Wall Street Journal, I said this in part one, that Harvard Endowment Fund, they invest in equities, they invest in fixed income, but what they have done is they have really expanded into hedge funds and private equity. That's why they have such a high internal rate of return on their endowment fund. Yeah, monitor and manage liquidity risk carefully. Boy, I could say this for almost every LOS that's out there. The Institute is super keen on monitoring. The Institute is super keen on being able to identify liquidity needs and then manage that liquidity risk. And so that's not a surprise that you see there. Regularly review, so monitor, review. Implement a spending policy. So this probably links back with the board of directors or the board of trustees who have an idea of the strategic plan. Most colleges have, what they call, some kind of a 5-year plan where we want to do, these 5 things during the next 5 years. So we put that goal inside of the larger, let me go back here real quick, inside of that larger goal of maintaining purchasing power indefinitely. Yeah, ensures year-to-year budget stability. That makes perfect sense. Here's just a summary of what I just described. What does a primary investment objective sound like? To achieve a total real rate of return of 10% with expected volatility of 14%. I made up those numbers, whatever that is. And then, of course, we want to outperform a benchmark. And we want to make certain that whatever our peers are doing, that we want to beat those. That makes great sense at all. Key investment strategies. Large endowments rely heavily on alternative investments. Large endowments are those that are, in the billions of dollars. Small investments are those that are, probably less than $100 million. So as the endowment fund grows, it's probably going to leak over into alternative investments. Yeah, size matters. We talked about this in part one. I know that. Graphic diversification, fixed income allocation. What are trends? Yeah, larger endowments have increased allocation to alternatives. That makes sense. Yeah, this is good news for the big guys and bad news for the small guys. Large endowments typically yield higher returns, and that's mostly because of their higher allocation in the alternative investment universe. Yeah, cautionary notes there. Supply and demand, marginal cost, marginal benefit, opportunity cost. Let's go back to all of our economics principles here. What we need to do is say something like, look, we have this board and then we have this investment committee, whatever that committee is called, and that committee is going to direct based on the strategic allocation that it gets from the board, maybe there's some tactical shifts in there. We're going to say, hey, these are the best stocks and bonds and alternatives. But how many individuals do we need? Do we need to hire an external management team of 100 people or 5 people, right? So consider the size and capabilities of the investment team. All right, go ahead and take a picture of this one here with your phone. Private foundations support the mission, whatever that is. I talked at length about that back in part 1. These foundations probably have some kind of a legal obligation to pay out a minimum of 5%. If they don't, then they're subject to tax on that, call that whatever they didn't spend. If they spent 3%, which means they didn't spend 2% to get to the 5%. So there's a tax on that 2%. So it doesn't make any sense for a foundation ever to not spend 5%, unless of course the foundation mission is to help out the federal government in increasing its tax revenue. Lots of times these return objectives sound an awful lot like, hey, you know what? Whatever inflation is, maybe it's defined by CPI, maybe it's defined by PPI, maybe it's defined by Jim's inflation index, JII, whatever it is. Let's add something on top of that. We want to get inflation. We want to keep pace with inflation. What does that mean? Maintaining purchasing power. And we want to add 4% or 5% or 10%. With reasonable standard deviations, here we said, 10 to 15% over 3 to 5 years. There's a reference to benchmarking. How do we do this? Liquidity modeling, which we talked about earlier. And there are lots and lots of different models to do this, not least of which is, that asset liability management. And then I love the whole Monte Carlo. You've heard me say this many, many times in previous recordings. Have somebody who's way smarter than you or I put together an algorithm and say, you know what, we've got our assets over here and we have this 5%. So what we want to do is we want to say, all right, what can we do? We can change each of these little variables, just one little angstrom at a time, run this through 50,000 iterations. And so we have all of the idea of, what's the best case scenario, what's the worst case scenario, what's everything in between. And we rely on Monte Carlo to do that. You want to take another picture of this one, asset allocation. Private foundations, they can invest in almost anything that they want, right? Higher allocation to alternatives for larger ones, that makes a lot of sense. Aim to return a real return over 5%, maintain purchasing power, same kind of things that we just talked about. How about for banks and insurers? This is a little bit of a repeat, right? Manage the bank's liquidity, manage the bank's risk position. The only way we can do that is by taking a look at the left-hand side of the balance sheet and the right-hand side of the balance sheet. And so this is so important that the Institute has emphasized this idea, which is a relatively recent phenomenon, this Asset Liability Management Committee. And so what you need to do is just type in ALMCO and SV Bank and see what you get about that. Clearly there was little asset liability management going on with SV Bank. Yeah, so what's the role down there? Sets the investment policy statement, monitors the performance balance sheet. That makes perfect sense here. So what does this committee do for us? It helps us in almost everything that the Institute has been teaching us since the very beginning of level 1 as it relates to the policy statement. So there we have benchmarking, there we have performance. Oh, my favorite words, some of my favorite words, there we go, duration and convexity. We worry about our peers and we monitor, we review, we adjust. So that's all part of that regular reporting. And investment objectives of insurance companies. Well, let me go ahead and say this again. What's the objective of an insurance company? When somebody dies, or when somebody crashes their car, when somebody's house gets flooded in the basement and they need $10,000, that we have $10,000. By the way, that we're legally obligated to pay to pay our policyholder. We have that $10,000 to help them. All right, so how can we chop this into a more formal presentation? So this is what the Institute does for us. Liquidity management, right? We need to have that liquidity. So it makes sense then, as part of the investment objective for an insurance company, to have a bunch of treasury securities laying around, right? So that if somehow we have a run on deaths, well, all we need to do is sell our treasury securities. That's part of liquidity management. Long-term growth, right? We're going to have a surplus if we're an insurance company. How are we going to maximize the growth of that surplus? Boy, we have all different sorts of risks there. Market risk, credit risk, interest rate risk, foreign exchange risk, all sorts of risks in there that we need to manage. And remember, I've said this to you multiple times, not only is important in this risk management process, but let's go through the steps. Identify the risk, quantify the risks, and then manage the risk through all different sorts of things. I mean, we can avoid the risk, we can use derivative securities. We're an insurance company, right? So we're probably going to use some kind of contracts. There are reinsurance companies out there. If we don't like this particular pool, we can send it over to those people. What did we say earlier? We used the word complex regulatory environment, so you need to worry about all that. And of course, we want to be efficient in our after-tax returns. All right, so this is a summation of what I was just saying here. Of course, we want lots and lots of highly liquid assets, but we can invest in less liquid assets. The great example is, oh boy, I'm hoping you guys know who David Bowie is. I'm a great rock and roll dude. David Bowie in the 1990s, he was one of the first guys who was on top of the internet. Can you imagine a time without the internet? And he put together like the first of access for his fans to have access to whatever it is that he did back then. But somewhere in 1997 or 1998, through an investment banker who was friends with all these rock and roll dudes, he went ahead and issued what are called these David Bowie bonds. And I think it was, I don't know, $50 or $60 million. And it had a high coupon rate, maybe 7% or 8%, some number like that. And Prudential Securities, they bought all these bonds. They were, I don't know, 20-year bonds, whatever they were. And Prudential Securities, they held on to them. And I think they held on to them because of things like Napster. Do you remember Napster? This illegal file sharing. And so we weren't quite sure if these rock and roll stars or any musicians were ever going to be able to make any money because people were just stealing MP3 files back over the days. But at least as reported in the Wall Street Journal, it appears as though Prudential Security received all of their coupon payments and their maturity payments from this bond. David Bowie got a bunch of money so he could build a recording studio. And then every time someone bought the great Young American song, then that helped go to those coupon payments. So less liquid assets. These are perfectly acceptable for insurance companies. Yeah, real estate, of course, rental, residential real estate, commercial real estate. Portfolio diversification, I don't have to tell you about how important that is. Regular asset allocation review, that makes a lot of sense. Key aspects of this balance sheet management. For banks, what do banks? They have deposits, which essentially has a zero duration. Well, how do you manage a zero duration over on the left-hand side of the balance sheet? Well, you have to do a bunch of other stuff, right? So fund obligations, deposits, policy claims, even derivative payoffs. Those financial claims are measurable. That's all part of the identify risk and quantify or measure the risk. There we go. Probabilistic methods, including things like Monte Carlo and including things like stress testing and including things like value at risk. Banks and insurers maximize the market value. That goes back to Modigliani and Miller in 1958. And so we're going to use this LDI as the primary strategy. Now, this LOS described considerations of the balance sheet. This sounds an awful lot like this is going to be really, really dull. When you look at that green box and you say assets equals liabilities plus equity. And you're saying to me, you know what, Jim, I learned this back in my very first accounting class. It was dull back then and it's dull now. Tell me something that's interesting. Well, what I'm going to show you over the next couple of slides is that we can use that fundamental accounting relationship, which, by the way, is not dull to accountants. And it shouldn't be dull to financial managers and financial analysts either, but it could be. But look at the second line. What we can do is we can say, well, if assets must equal liabilities plus equity, then any change in the assets, there's the little triangle for delta, any change in the assets, that must equal the change in the liabilities plus the change in the equity. And you might not think that's very interesting at first, but man, it becomes super cool as we're trying to evaluate our risk management strategies for handling all of those risks for banks and insurance companies. So let me just give you a quick example here. Suppose the assets go up by 10. Well, that means that the liabilities, they could have gone up by 8 and the equity could have gone up by 2 or any other combination of capital structure over on that right-hand side. But what makes it more interesting is that suppose the assets go up by 10 and the liabilities go down. Well, that means the equity has to go up by an even greater amount to kind of offset those. Now, when I got to graduate school, and I know I tell these stories to you that probably don't have any meaning, but I do tell them for reasons. When I got to graduate school, and I started learning the applications of not just geometry and algebra, but calculus to finance decisions, I learned the value of trickeration, and this is what I called it. I think trickeration comes from an ESPN analyst when they were talking about football plays. But trickeration in calculus is doing something that might not make any sense until you look at the motivation behind this trickeration. So look at the second block point there. Suppose you multiply everything by 1. Well, you know from kindergarten that when you multiply something by 1, you get the same thing. So your first thought is, well, Jim, if we multiply or divide something by 1, it doesn't change anything. But let's look at 1 as a numerator. Like, look what we have in parentheses. You can have A divided by A or L divided by L. Well, that's 1, right? So you can multiply or divide by A divided by A, and it doesn't change the equality. But let's suppose that we take that second equation and we go ahead and we multiply by 1. A times A divided by A, and we multiply by 1, L divided by L, and then we divide both sides of the equal sign by E. This is just regular old standard algebraic stuff. And if we move things around, we get the following equation. The percentage change in equity is equal to the percentage change in assets minus the percentage change in liability. So that holds with that very first equation up top, right? However, when you do that dividing by A and you do the dividing by L, what you do is you get something that we call a leverage multiplier. And that's defined by A divided by E. And that's what we put in red down there. Now, the reading doesn't give it another notation. We do. That's the M inside of that equation. So M is equal to A divided by E. So think about what we can do. The percentage change in equity is equal to the percentage change in the assets multiplied by some leverage multiplier, right? We're going to see how much debt we have in the capital structure and how much that impacts the value of equity. And then we're going to subtract the percentage change in leverage, and we're going to adjust that by the leverage multiplier. And in the whole algebra, don't really worry about how it comes out. It turns out to be M minus 1. All right, so bear with me. What you're saying to yourself is, all right, Jim, all we've done is we've added a leverage indicator. The Institute calls it a leverage multiplier. But how leverage impacts the value of our equity, right? What's the goal of the business? Maximize shareholder wealth. How do we do it? Well, we issue a bond. We use somebody else's money and we make them a fixed promise. We say, look, no matter how profitable we are, we're only paying you $10 every month, right? Whatever that coupon payment is. And so if we make $100 a month, all we do is we pay them 10 and we get to keep 90, right? That's the beauty of leverage. So what this model, this super dull accounting model is allowing us to do is to determine how leverage impacts the value of the equity. And of course, we're going to go through a problem here. So let's suppose we have a financial institution, equity to asset ratio of 8%. Compute the projected percentage change in the market value of equity if our liabilities increase by 2%. And then look at the end, and assets remained unchanged. All right, so that's an important kind of a caveat at the end there. All right, so there's our equity to asset ratio. So we're not surprised that this credit union is funded 92% by leverage. So that's tons and tons of leverage, right? So the leverage multiplier, take the reciprocal of 8%, so you get 12.5 times. And so let's just plug that 12.5%, I'm sorry, that 12.5 times, and then minus 1, that gives us the 11.5 times. And then the, what did we say? Liabilities are increasing by 2%. In this simple equation here, what we can do is make the conclusion that if we increase liabilities by just 2%, but there are no change in assets, and that's a big assumption there, then that means that the market value of our equity has to decrease by 23%. Wow, what does this mean? Stock price falls, right? That makes perfect sense. What do we need to know? We need to know all of this stuff before we make a leverage decision. Now, as you can imagine from that previous slide, the increase in liabilities is going to increase the volatility of the equity. So how do we manage that volatility of the shareholders' capital? Wow, how do we do this? Well, portfolio investments, right? We make loans, and we can use derivatives. What this does is that it lessens the shocks, all right? So this is all part of identifying the risk, quantifying the risk, which we just did in that previous slide, and now manage the risks, all right? So we know, here, let me go back here. We know that we've got this 23% decrease in the market value of equity. How can we manage this? Well, we can throw some kind of an interest rate call option or a put option or something in there, or we can make loans to a specific client, or lots of stuff we can do. This helps us control leverage. All right, so this is really, really cool stuff. But what gets even cooler is the concept of an equity duration. Now, you may pause and say to me, wait a minute, Jim, we know that if we buy a share of stock, that company, they could generate operating cash flows forever and ever, right? Over an infinite time period. And as a shareholder, if the board pays a dividend, we could receive a dividend forever and ever. So isn't equity duration an infinite time period? And I can't really argue with that because of course companies ought to be around for a really, really long time, but we know that they're not going to be around a really, really long time. So what we can do is we can use that previous model and here, let me go back here. And instead of, I'll go back all the way to here. Instead of percentage change in equity, percentage change in assets, percentage change in liabilities, let's go ahead and throw duration in there. We can say that the duration of the equity is a weighted average combination of the duration of the assets and the duration of the liabilities. Now we have to adjust it by that leverage factor that we just talked about in the previous slides. And then over on the far right, what we're doing is we're going to adjust the duration of the liabilities by the change in the yield on the liabilities, that's the delta I, versus the change in the yield on the assets, there's the delta Y. So think about this. What is duration? It's a measure of interest rate risk. What are we doing here? We're trying to quantify a measure of duration of our equity capital for banks and insurance companies, right? This makes perfect sense to try to put a time limit. Boy, I don't want to call duration as a time limit. Remember, it's a weighted average time to maturity, but you can do this using the fundamental accounting equation. And so, of course, let's go ahead and work through a quick example. So let's suppose we've got this equity capital ratio of 15%. What we want to do is we want to modify that to decrease it to 12%. Our modified duration of liabilities is 2.4. We want to reach a modified duration of assets to 2.6. And so here are our adjustments. So the yield on liabilities, 70 basis points for every 100 basis points yield change in the asset portfolio. So here we go. Calculate the modified duration of Paramount's equity capital. So we can just substitute all of those input variables, throw them together, do a little bit of math, and you get a duration of equity of 9.34 years. Think about how much this adds to our understanding of how to manage, boy, here we are, financial institutions, right? We're banks and insurance companies. What's that risk? The risk is that we're not be able to pay our depositors. We're not be able to pay our certificate of depositors. We're not be able to pay our bondholders, right? For insurance companies, we're not going to be able to pay our claims. Think about how cool it is to know the modified duration of our equity is, in this case, almost 9.5 years. What we're going to do is we're going to couple that with the duration of our liabilities, there we go, 2.4, and the duration of our assets, 2.6. Oh my goodness gracious. So now we have a measure of duration of each component of the balance sheet, which puts us in a much better position to manage risk. Oh my gosh, that was super cool. Now, what did I say just a few slides ago? What did we have? A 23% drop in equity value, right? So how can we do that over time? Well, I hinted about this. I'm not quite sure I said it explicitly, but there's going to be a standard deviation of our equity. And what did we say in some of those slides that I asked you to take a picture? Some of those said, hey, we want volatility or standard deviation to be between 10 and 15%, or between 15 and 20%, or whatever that is. So once again, we're going to use that fundamental accounting equation adjusted by this leverage consideration to estimate the standard deviation of our equity. There's the equation there, standard deviation squared. So there's the variance of the equity, and it's equal to all that stuff that we've done back in Harry Markowitz. Notice that we have on the far right-hand side the correlation coefficient. And this is going to be the correlation between the percentage change in value of the assets versus the change in the value of the liabilities. So let's see how cool this is here with the final example. All right. Let's see. Volatility, 6% and 3%, part of the strategic financial plan. We have correlations of 0.3. Common equity financial asset ratio 25%. Calculate the volatility of changes. All right, so all we're going to do is input those, and you do some quick math, and you get 23% a year. Once again, this adds tremendous value to our understanding of risk management for banks and insurance companies. All right, the last part of this LOS asks us to manage that volatility. So I'm going to repeat it again. Identify the risks, quantify the risks, which we've just done, and now how do we manage this? All right, so we're going to hold diversified portfolios, maintain similar asset and liability durations. And I'm going to go ahead and make certain, the reading doesn't emphasize this, but I'm just going to say this. When you throw duration in there and you put a period, you're kind of assuming that convexity is close to zero. But I always tell my students, put a comma after there and say, you know what, convexity, it might be zero, but it might not be. So we need to make sure we consider duration and convexity. And I'm guessing that I can promise you that, if you're doing this in an essay question and you mention duration and convexity, the grader is going to say, oh my gosh, convexity. Yeah, that's not part of the rubric of the standard answer, but hey, that's an indication that this candidate is thinking clearly. Improve derivative transparency and collateralization. All right, you guys know that I love the use of derivative securities. There's some liquidity issues, diversifying insurance businesses. So yeah, we're going to insure, if we're insuring an apartment complex, then let's go insure a miniature golf course. Whew, boy, that takes us through all these. We had to do a part 1 and a part 2. So what I want you to do now is I want you to go to the end of this reading, and I want you to give yourself maybe 45 minutes. I think there are 18 questions, and I have looked through all those 18 questions, and we've covered all of this stuff. So you ought to be able to come out of that with a passing grade. So thanks for studying with me today. Have a great day, and I'll see you next time.